Welcome to Module 11, where we'll be focusing on investment analysis and the taxation of income properties. This module will guide you through understanding how to evaluate income properties as investments and how taxation impacts their profitability. We'll cover key concepts that are essential for making informed decisions in real estate investment, including calculating returns and understanding tax obligations related to these properties. Let's dive in and explore how to analyze income properties effectively and optimize your investment outcomes. On this slide, we outline the main topics we'll be covering today. First, we'll dive into the fundamentals of financial analysis, focusing on key metrics like net operating income, cap rate, cash flow, and return on investment. I'll explain how each of these is calculated and what insights the numbers provide about a property's performance. Next, we'll move into taxation and deductions, discussing deductible operating expenses, how depreciation affects taxable income, and ultimately, how to evaluate after-tax cash flow and overall profitability. Finally, we'll look at investment decision-making. Here, we'll learn how to compare different opportunities using consistent metrics, identify weaker deals or hidden risks, and assess long-term viability through real-world examples. Together, these sections will give you a comprehensive understanding of analyzing and investing in income properties. Let's take a closer look at the real estate investment landscape, focusing on four main property types: multifamily, office, retail, and mixed use. Each of these offers unique market reach and investor appeal, combining both income and growth potential. The key idea here is balancing cash flow today with appreciation tomorrow, ensuring both immediate returns and long-term value. From a performance perspective, metrics like net operating income, capitalization rate, and return on investment are essential. They help us make smarter, data-driven decisions. Another important consideration is depreciation and how tax rules can significantly impact real returns. Understanding these tax advantages is crucial when analyzing income properties, as they can enhance overall investment outcomes. Here, we're looking at the concept of net operating income, or NOI, which is crucial in real estate investment analysis and taxation. First, let's break down operating income. It includes various revenue streams from the property, such as rent, parking fees, laundry income, storage fees, pet fees, and other miscellaneous revenue sources. These collectively form the gross operating income. On the flip side, we have operating expenses, which are the costs associated with running and maintaining the property. These include maintenance, insurance, property management fees, utilities, property taxes, and repairs. NOI is calculated by taking the gross operating income and subtracting all these operating expenses. Essentially, it represents a property's income from its core operations before accounting for financing costs and taxes. Understanding NOI is fundamental because it helps investors assess the profitability and potential return of an income property. Now, let's look at how net operating income, or NOI, works in practice, using an example of a 20-unit apartment complex. Each unit rents for about $1,200 per month, with an occupancy rate of 95%, meaning most units are rented out consistently. There's also an additional $6,000 generated from other income sources. The property was purchased for $2.1 million. To calculate the annual NOI, we start with the gross rental income, which is $288,000. Adding the other income of $6,000 gives us the effective gross income, totaling $294,000. Next, we subtract operating expenses, including property taxes at $32,000, insurance at $8,500, maintenance costs of $24,000, management fees of $17,500, and utilities costing $14,000. Altogether, these expenses add up to $96,000. When we subtract these operating expenses from the effective gross income, we're left with a net operating income of $198,000. This figure is crucial because it shows the property's performance before factoring in financing costs like mortgage payments or taxes. Understanding NOI helps investors analyze the profitability of an income property on a pure operational basis. The capitalization rate, or cap rate, is a key metric in real estate investing that helps us understand the unleveraged return on an income property. Essentially, it tells us the return we'd expect if we bought the property entirely with cash, without using any financing. To calculate the cap rate, we take the net operating income, which is a property's income after operating expenses, but before debt service and taxes, and divide it by the property purchase price. This ratio gives us a clear snapshot of the investment's potential return. Investors often interpret cap rates in the context of the market, property type, and risk level, so the meaning of a good cap rate can vary. For example, a low cap rate between 3 and 5% usually indicates lower yield, but often corresponds to properties in stronger locations or with lower perceived risk. A medium cap rate, in the range of 5 to 8%, tends to represent a balanced return profile commonly seen in many stabilized investments. Finally, a high cap rate over 8% reflects a higher yield, but this is generally tied to greater risk or more intensive property management. Understanding these distinctions helps investors make informed decisions by balancing expected returns against the risks they're willing to take. Here we have a comparison of cap rates, which are essential tools for investors when making decisions about income properties. Cap rates offer a quick way to evaluate value, risk, and potential income by comparing similar properties. Generally, a higher cap rate indicates a higher potential return, but it also usually comes with greater risk. Looking at property A, we see a stabilized suburban retail asset with a cap rate of 5%. This is calculated by dividing the net operating income, which is $60,000, by the purchase price of $1,200,000. On the other hand, property B is an emerging market multifamily property with a cap rate of 8%, based on $80,000 in NOI and a $1 million purchase price. While property B appears more attractive if we focus strictly on income yield, the decision isn't just about numbers. Investors need to consider the location, market stability, and associated risks before choosing a property with a higher cap rate. This balanced approach helps to assess both opportunities and potential pitfalls in the investment. Let's talk about cash flow, which is a core investment metric when it comes to income properties. Think of cash flow as the lifeblood of these investments. Essentially, it's the money left over after you pay all operating expenses and your debt service from the rental income. Why is this so important? First, positive cash flow keeps the property self-supporting every month, so you aren't constantly putting in your own money. It also helps you build reserves for times when the property might be vacant, needs repairs, or unexpected expenses come up. On top of that, cash flow creates real, tangible income while your property also appreciates in value over time. As an investor, your focus should always be on monitoring cash inflows and outflows closely and continuously to ensure the property remains profitable. This is a key part of investment analysis and also impacts how income properties are taxed. Understanding and managing cash flow effectively is critical to making smart, successful real estate investments. Let's talk about how to calculate the annual cash flow from an income property. The process starts with the net operating income, or NOI, which is essentially the income left after all operating expenses are paid. From that amount, we subtract the debt service, which covers both the principal and interest payments on any mortgage. Next, we deduct capital expenditures and reserves. These include costs for major repairs or replacements like roofing, HVAC systems, or other future property maintenance. After these deductions, what remains is the actual cash flow available to the investor. This figure represents the real dollars left after covering both financing costs and reinvesting back into property to maintain its value. Understanding this calculation is crucial for evaluating the profitability of an investment property. Here we're focusing on the core formula for calculating return on investment, or ROI. The formula is simple. ROI equals the annual cash flow divided by the initial cash investment. Let's break down an example. Suppose you're purchasing a property for $500,000 and you put down a 25% down payment. That means your initial cash investment is $125,000. Now, let's say after covering all operating costs and debt service, the property generates $12,000 in annual cash flow. This is the money you actually keep each year. To find the ROI, you divide the $12,000 annual cash flow by your $125,000 initial investment. Doing the math, that's 9.6%. So, for every dollar you invest up front, you're earning about 9.6 cents back annually. This percentage is a key indicator of how well your investment is performing and is critical in analyzing and comparing income properties. Now, let's talk about deductible expenses for income properties. These are important because they directly reduce your taxable income, which in turn improves your after-tax investment performance. Some of the key deductible expenses include mortgage interest, property taxes, and insurance. You can also deduct costs for maintenance and repairs, utilities, and property management fees if you hire someone to manage the property. Depreciation is another critical expense to understand. It allows you to recover the cost of the property over time as a non-cash deduction. Additionally, homeowners association fees, legal fees, and accounting fees related to property are also deductible. Recognizing and accurately accounting for these expenses can significantly impact your overall investment returns. Depreciation is a powerful concept when it comes to investment properties, especially because it allows investors to reduce their taxable income without any actual cash leaving their pocket. Essentially, depreciation is a non-cash deduction, meaning it lowers the tax bill by accounting for the wear and tear of the building over time, but it doesn't involve spending money each year. It's important to note that only the value of the building itself is depreciable. Land is excluded because it doesn't wear out or get used up like a building does. So for tax purposes, it's not considered. When you apply depreciation, taxable income goes down, even though the investor hasn't made an actual cash payment. This often makes a property appear less profitable on paper than it really is in terms of cash flow. The way depreciation is calculated for residential properties is by subtracting the land value from the total property value, then dividing the remaining building value by its useful life, which is set at 27.5 years. For example, if you have a $400,000 building, you divide that amount by 27.5 years to get an annual depreciation deduction of about $14,500. This deduction helps reduce taxable income each year, providing a significant tax benefit to property investors. Here, we're looking at the difference between taxable income and cash flow, which is a crucial concept for real estate investors to understand. A property can generate positive cash flow, meaning you actually have money left in your pocket after all expenses and debt payments are made. In this example, that amount is $15,000 annually. However, when we factor in depreciation, a non-cash expense used for tax purposes, it's possible for properties to show little or even negative taxable income. Depreciation can shelter your income from taxes without affecting the actual cash you receive. So, while your tax return might show a loss of $3,000, this doesn't mean you are losing cash. The $15,000 cash flow remains intact. This highlights how tax rules, especially depreciation, can impact the reported taxable income differently from the real cash generated by the property. Understanding this difference helps in making smarter investment decisions and optimizing tax benefits. Here, we're focusing on how to calculate after-tax cash flow, which essentially translates pre-tax income into the amount an investor actually gets to keep. The combined tax rate, which includes both federal and state taxes, is 29%. That's 24% federal and 5% state. This rate can significantly reduce your returns. For example, from an $18,000 annual pre-tax return, taxes could take away $5,220. There are two main methods to calculate after-tax cash flow. The shortcut method involves multiplying your annual cash flow by 1 minus the tax rate. So, with $18,000 in cash flow and a 29% tax rate, you multiply $18,000 by 0.71, which equals $12,780. The tax-first method calculates after-tax cash flow by first figuring out the tax due. You multiply the pre-tax income by the tax rate to find the tax owed. In this case, $5,220. Then, subtract that from the pre-tax income, leaving you with the same $12,780 after-tax cash flow. Both methods lead to the same result, showing that out of an $18,000 pre-tax cash flow, after paying $5,220 in taxes, the investor is left with $12,780. Understanding this helps investors more accurately assess their true earnings from an investment property after taxes. When it comes to managing your investment properties, small expenses can really add up and make a difference. One of the key points to remember is that overlooked deductions can meaningfully lower your taxable income, so it's crucial to be thorough. For example, if you have a home office used to manage your rental properties and keep records, that space might qualify for a deduction. Also, don't forget about property travel. Mileage for trips to inspect or maintain your rentals can be deductible. It's important to distinguish between repairs and improvements. Immediate repairs can be deducted differently compared to capital upgrades, which usually need to be depreciated over time. Legal fees related to homeowners association disputes might qualify as well, so keep track of those. Advertising costs such as tenant listings, signs, and marketing expenses are also deductible. Finally, software subscriptions for accounting, tenant screening, and property management tools can be included, helping you manage your properties efficiently while reducing your taxable income. These common deductions, when accounted for properly, can significantly benefit your tax situation. Let's talk about the difference between short-term and long-term capital gains and how it impacts your taxes when you sell an investment. Short-term gains apply when you hold an asset for less than 1 year. These gains are taxed at your ordinary income tax rate. For example, if you have a $100,000 gain and you're in the 37% tax bracket, you would pay $37,000 in taxes. This higher tax rate can significantly reduce your net proceeds from the sale. On the other hand, long-term gains apply to assets held for more than 1 year. These are taxed at the preferential capital gains rates, which are generally much lower. Using the same $100,000 gain example, if you're taxed at 20%, you would owe $20,000 in taxes, preserving more of your after-tax profit. By simply crossing that 1 year holding period, you could save about $17,000 in taxes on a $100,000 gain. This difference is crucial when planning your investments and timing sales to maximize your returns. Here we're discussing the 1031 exchange, which is a powerful tool for deferring capital gains taxes. The process starts by selling your current investment property. Instead of cashing out and paying taxes right away, you reinvest the proceeds into a like-kind property. The key is that the new property must be similar in nature to the one you sold. To defer the capital gains taxes, you have to follow specific IRS timing rules. You have 45 days from the sale to identify potential replacement properties. Then, you must complete the purchase of the new property within 180 days. Meeting these deadlines is crucial to qualify for the tax deferral. This strategy allows you to reposition your investment strategically. By using a 1031 exchange, you can move your equity forward into a new property without triggering an immediate tax bill, which can significantly enhance your investment growth over time. Let's walk through the investment analysis workflow from the initial evaluation to the final decision. First, we start by identifying the property that we're interested in. Once we have the property selected, the next step is to calculate the net operating income, or NOI, which gives us a clear picture of the property's profitability before financing and taxes. After we determine the NOI, we calculate the capitalization rate, or cap rate, which helps us understand the expected rate of return based on the property's income. Moving on, we project the cash flow to see how much actual cash the property will generate over time. Following that, it's important to estimate the tax impact because taxes can significantly affect net returns. Once we have this, we calculate the after-tax return on investment, providing a realistic measure of profitability after all expenses and taxes. With all this information, we compare the results to our established investment criteria to see if the opportunity meets our goals. Finally, based on this comprehensive analysis, we make a go or no-go decision on whether to proceed with the investment. This structured approach ensures that we thoroughly evaluate income properties and make informed investment choices. Here we have a real-world scenario involving a duplex investment. The acquisition price of the duplex is $400,000 with a down payment of $80,000 and a mortgage covering the remaining $320,000. The property generates gross rents of $48,000 annually. From that, we subtract operating expenses, which are estimated at $14,000 per year, and mortgage payments totaling $22,000 annually. After covering these costs, we analyze what's left by calculating the net operating income, or NOI, along with the cash flow and return on investment, or ROI. This approach helps us understand the true profitability of the property by looking at both income and expenses, as well as the impact of financing. This example provides a tangible two-unit asset with real operating numbers, making a practical case to demonstrate investment analysis and how taxation of income properties might affect the overall financial picture. Now, let's break down the financial performance of this duplex investment and how taxes impact the bottom line. The net operating income, or NOI, is $34,000. This figure represents the income generated after covering operating expenses, but before any debt service or taxes are taken out. The capitalization rate, which is the NOI divided by the property value, comes in at 8.5%, indicating the property's return relative to its price. Annual cash flow, what's left after paying debt service, is $12,000. When you look at return on investment, or ROI, which compares the annual cash flow to the amount of cash invested, it stands at a solid 15%. However, things change once we consider taxes. With depreciation factored in, taxable income is reduced to $20,000, and applying an assumed 30% tax rate means the taxes owed amount to $6,000. That leaves the after-tax cash flow at $6,000, cutting the cash actually available nearly in half. This shows how depreciation can lower taxable income and help preserve cash flow, even though it doesn't reduce the actual cash received. Ultimately, while the property performs well at the operating level, the impact of taxes significantly narrows the net returns. Understanding these nuances is crucial for accurate investment analysis and planning. When evaluating an investment, it's crucial to recognize the red flags that signal when to walk away. The first and most important point is that a weak deal often reveals itself in the numbers before any physical issues appear in the property. If the risk starts rising faster than potential income, that's a clear sign to pause. One key red flag is a cap rate below the market average. If your returns are trailing comparable properties, you might be overpaying for what the property generates. Negative cash flow is another serious warning. If you have to consistently put money in each month just to cover expenses, the investment isn't sustainable. Watch out for vacancy rates above 15%. Persistent vacancies usually mean there's weak demand, poor property management, or the market simply doesn't want that property. Deferred maintenance is also a major concern because costly repairs often emerge after closing, turning what looked like a good deal into a financial burden. Rising expenses that outpace rent growth squeeze your net operating income and slowly erode the property's value. Lastly, be cautious of declining market fundamentals, such as weak employment, falling rents, or too much supply. These can all turn otherwise decent investment into a poor one. Keeping these red flags in mind will help you make smarter, more disciplined investment decisions. Here we have a comparison of two investment opportunities, Property A and Property B. Property B clearly wins when it comes to income and returns, offering higher annual rents, net operating income, and cash flow. It also has a better cap rate and a stronger overall return on investment. On the other hand, Property A stands out for its lower purchase price, smaller down payment, and lower mortgage payments, which make it a simpler and less risky entry point. It also results in lower taxable income and estimated taxes, which is an advantage for investors focused on minimizing tax exposure. So, the key takeaway here is to choose the asset that aligns with your personal investment goals. If you're looking for stability, lower cash requirements, and less debt, Property A is a solid, conservative choice. But if you're aiming for a higher performance, growth in income, and better after-tax cash flow, Property B is the better option. Understanding your cash flow targets, comfort with financing, and tax strategy will guide you to the property that best fits your investor profile. When choosing the ownership structure for a property, it's crucial to understand how it can affect taxation, liability protection, and the income that ultimately reaches the investor. The same property can lead to very different tax outcomes, depending on its ownership form. Starting with a sole proprietorship, the income passes directly through to the owner's tax return, making filing simple. However, there's no liability shield, so the owner is personally responsible for any debts or legal issues. Partnerships also use pass-through taxation, but at the partnership return level. Liability varies depending on the partner type and agreement, and income, losses, and depreciation are allocated among partners, providing some flexibility. Limited liability companies, or LLCs, usually provide pass-through taxation unless a corporate election is made. They are popular for rental properties because they offer strong personal liability protection combined with operational flexibility. S corporations pass income through to shareholders and offer a corporate liability shield. They can reduce self-employment taxes, but are less commonly used for holding rental properties. Finally, C corporations are taxed at the corporate level, and owners enjoy full liability protection. However, profits distributed as dividends may face double taxation, which can impact overall returns. So, when evaluating ownership options, carefully weigh taxation, liability protection, and how income flows to you as the investor to choose the best structure for your investment goals. When we talk about protecting the income stream from an investment property, risk management and insurance play a crucial role. Insurance coverage essentially transforms unexpected events or surprises into manageable expenses, helping to shield your investment from financial shocks. Most insurance premiums are considered operating expenses, which means they are generally deductible, providing a tax advantage. Let's break down some key types of insurance you should consider. First, property insurance protects the physical asset itself, such as a building. The premiums you pay for property insurance are usually deductible, which helps reduce your taxable income. Next, liability coverage is vital because it covers claims and lawsuits that might arise from accidents or damages related to your property. This coverage is typically deductible as well, providing an added layer of protection. Loss of rent insurance is designed to offset income interruptions if your property becomes uninhabitable or vacant due to a covered event. Like other insurances, premiums for loss of rent insurance are generally deductible. Then we have umbrella policies, which add an extra layer of protection beyond your standard liability limits. These are often deductible for rental properties and can be invaluable in safeguarding your investments against significant claims. Finally, active oversight and management are essential in reducing risks before they turn into losses. Proactively assessing and managing potential issues can save you from costly claims and maintain the stability of your income. Understanding these insurance types and their tax implications is a key part of effective investment analysis and safeguarding your income properties. When building long-term wealth through real estate, the key is to let income, equity growth, and tax advantages work together over time. A durable strategy follows a clear, repeatable progression. First, by acquiring a property with strong rental potential and manageable financing. This sets a solid foundation. Next, collect cash flow. Use the rental income to cover debt payments, maintain reserves, and fund future property acquisitions. Then, focus on building equity. As you pay down the loan and the property appreciates, your net worth grows year after year. Finally, sell or refinance to harvest your gains or redeploy capital into the next opportunity. Remember, wealth isn't built from a single deal, but through consistent repetition. Cash flow provides stability and the ability to reinvest, while appreciation and amortization quietly expand your equity. Strategic exits help convert one property into a larger, more diversified portfolio over time. This thoughtful approach is essential to maximizing both investment returns and tax benefits in income properties. Here are the 7 key metrics that transform a property's story into a solid investment decision. First, there's NOI, or net operating income, which is simply gross income minus operating expenses. This tells us the property's income before debt service and taxes, giving insight into its core operating performance. Next, the cap rate, calculated by dividing NOI by the property value, represents the unleveraged yield and is especially useful for comparing prices across similar properties. Moving on, cash flow is NOI minus debt service, showing the actual pre-tax cash left after mortgage payments. ROI, or return on investment, is annual cash flow divided by cash invested, reflecting how effectively your invested dollars are working for you. Then we have taxable income, which is NOI minus interest and depreciation, indicating the income subject to tax after allowable deductions. After-tax cash flow is simply cash flow minus income taxes, revealing what the investor truly keeps after all operations, financing, and taxes. Finally, the expense ratio, operating expenses divided by gross income, shows how much revenue is consumed by operating costs. A lower ratio often indicates greater efficiency. These metrics are a quick reference guide to understanding the financial health and potential of an income property. When analyzing income properties, it's crucial to avoid some common mistakes that can lead to poor investment decisions. First, many investors ignore capital expenditure reserves. This means they don't set aside enough funds for major repairs or replacements like roofs and HVAC systems, which can inflate cash flow projections unrealistically. Second, using gross income instead of net income can be misleading. It's important to base decisions on the net operating income, which accounts for operating expenses, to get a clearer picture of profitability. Third, forgetting to factor in vacancy rates is a common error. Assuming full occupancy overstates potential returns, so including a realistic vacancy allowance is essential. Fourth, underestimating operating expenses such as taxes, repairs, insurance, and management costs can hurt your budget. Always stress test these figures to avoid surprises. Fifth, neglecting tax planning is a major oversight. Remember, pre-tax profit doesn't equal what the investor actually takes home. Modeling depreciation, deductions, and after-tax cash flow helps reveal the true financial picture. Finally, overestimating tenant demand by being overly optimistic about rents adds risk. Always verify assumptions with local market comps and absorption trends to make grounded projections. By being mindful of these pitfalls, you can make more informed and reliable income property investment decisions. To build strong investment analysis skills, it's important to go beyond just calculating numbers. The real goal is to confidently evaluate risk, return, and tax implications when making decisions. First, practice analyzing real deals by running metrics like NOI, cap rate, cash flow, and ROI on multiple properties, not just one. This will give you a broader understanding of how different variables affect outcomes. Second, use analysis software to model things like financing, vacancy rates, repairs, and exit strategies. This allows you to quickly test different scenarios and make more informed choices. Third, always consult with tax and legal experts to confirm important details like deductions, depreciation, entity structures, and compliance before finalizing any purchase. Fourth, keep a close eye on market trends, such as rent levels, interest rates, comparable properties, and operating costs in your target areas. Staying informed helps you anticipate changes and adjust your strategy. Lastly, build and nurture a solid network of professionals, including lenders, brokers, property managers, contractors, accountants, and experienced investors, to enhance both your analysis and execution capabilities. This comprehensive approach will help you make smarter, more confident investment decisions.